Hey everyone, and welcome to the Deep Dive. Today we are tackling a topic that gets thrown around a lot in finance, but that frankly few people truly seem to understand. Market efficiency.
Mhm.
And what an edge in the market, really. I mean, who doesn't?
Yeah,
But what does that even mean?
right.
Like, does anyone really know what makes this thing tick?
Right.
So today we are diving into an article from the Corporate Finance Institute to try to cut through some of the noise around this idea of market efficiency. We'll try to figure out what it actually means in practice and why it should even matter to you. So where do we even begin with something like this?
Well, the CFI article defines market efficiency as a metric measuring information dispersion in a market.
Okay, so right off the bat, we already have something that sounds like it's straight out of an economics textbook. Can we maybe unpack that a little?
Yeah.
Like, what are we really talking about when we say information dispersion?
Sure. So essentially, we are talking about a market where information about companies and their stock is spreading efficiently, meaning that it's kind of like instant and complete and free.
So it's like this perfect utopian flow of information where everybody's always in the know?
Yeah, you could think of it like that.
Okay, but, and here's the catch. How does this actually work in the real world? I mean, people love to gossip and hoard information, and let's be honest, we've all made a decision based on emotion rather than, cold, hard logic at some point.
It's true.
So is this whole market efficiency thing just a myth?
Well, that's the fascinating thing. Even though a perfectly efficient market is purely theoretical, the real world can still be surprisingly efficient. Think of it this way. Even with all the complexities of human behavior, and you know how messy information flow can be, the market kind of acts like this giant self-correcting organism. You've got all these individual investors, right? Each with their own little world of perspectives and information they are paying attention to. They're constantly buying and selling based on all that. And their actions, even when driven by emotions or incomplete information, they kind of balance each other out, leading to a surprisingly efficient outcome overall.
Okay, I think I see how that might work in theory. But it's still a bit abstract for me. Can you give me a real-world example to help me wrap my head around it?
Absolutely. Let's use Tesla as an example. Let's say hypothetically that they're about to announce this brand new electric vehicle with some revolutionary new battery technology.
Okay, so that sounds like a surefire way to send their stock price through the roof, right?
Yeah, you would think so, right? But in an efficient market, even groundbreaking news like that wouldn't necessarily cause a sudden, huge spike in Tesla's stock price.
Wait, really? Why not? It seems like everyone and their grandma would be rushing to buy Tesla stock if they knew this amazing new car was coming.
Right. But here's the thing. Investors and all these market analysts are already constantly tracking companies like Tesla. They are looking at industry trends and they're analyzing patents and they're picking up on rumors. All of this information, the anticipation of a new car model, the potential for increased market share, even the estimated production costs, it's all constantly being factored into Tesla's stock price.
So you're saying that even before the official announcement, the market has already kind of priced in the impact of this new electric vehicle. It's like the market can collectively sense these things coming.
Exactly. And that's why, in a truly efficient market, consistently predicting price movements based on news or even inside information, it becomes incredibly challenging.
So what does this mean for the average person who's just trying to understand the market and maybe even outperform it a little?
Well, it means that if you're looking to make a quick buck by timing the market or chasing the next hot stock tip, you're probably in for a wild and stressful ride.
Let me guess. It's not going to be easy.
In truly efficient markets, outsmarting everyone else consistently, it is incredibly difficult to do, even if you think you have some secret inside information.
So if markets are as efficient as you're saying, does that mean all those Wall Street analysts and all their fancy investment strategies are basically a waste of time? Like, should we all just throw our hands up and just invest in index funds? So if markets are as efficient as you're saying, does that mean all those Wall Street analysts and all their fancy investment strategies are basically a waste of time? Like, should we all just give up, throw our hands up, and just invest in index funds?
Well, that's a million-dollar question, isn't it? The truth is it's not quite that simple.
Okay, so it's not just a matter of going all in on index funds then.
Not necessarily. See, different markets operate with varying levels of efficiency. A market that's highly liquid and closely followed, like, say, the S&P 500, that's going to tend to exhibit a higher degree of efficiency.
Makes sense since there's so much information constantly flowing and everyone's watching every little move.
Exactly. But then you have more niche markets, maybe with smaller companies or where there's less public information available. Those might be less efficient, meaning there could be more opportunities for savvy investors to find those hidden gems.
Okay, so it's more like a spectrum of efficiency than
Yeah.
a black and white rule.
Yeah.
That makes sense. But for the average person who's just trying to grow their wealth, what's the key takeaway here for them?
I think the key is understanding that market efficiency isn't about abandoning all your investing strategies and just blindly throwing money at the market. It's about being realistic. It's about recognizing that information is power, but in an efficient market, that information is already baked into the price.
So how can we use that knowledge to our advantage then?
Instead of trying to outsmart everyone else, focus on developing a sound investment strategy that aligns with your personal risk tolerance and long-term goals.
This has been a fascinating deep dive into market efficiency. We've debunked some myths, explored some real-world examples, and hopefully given you a new understanding of how this concept can impact your investments. As always, knowledge is power, especially in the world of finance. We hope this deep dive into market efficiency has left you feeling a bit more confident and ready to tackle your own financial goals. Be sure to subscribe to the deep dive for more myth-busting explorations of the complex and often surprising world we live in.